Pipestone Capital Corp. Forfeiting in international trade, unlocking financial opportunities. In the dynamic world of international trade, forfeiting stands out as a strategic financial instrument that empowers exporters and facilitates seamless cross-border transactions. At the core of this process is the figure of the forfeiter, a key player connecting exporters and importers in a web of financial security. Understanding the forfeiter. A forfeiter, whether an individual or a company, acts as a bridge in forfeiting transactions. Their primary role involves connecting with exporters, assuming the responsibility of holding, selling, or guaranteeing payment obligations from importers. In essence, forfeiters function as risk mitigators in international trade, earning a margin for their expertise. Think of them as central clearing counterparties on the over-the-counter, OTC markets, where their involvement ensures a smoother flow of funds. Decoding forfeiting. Forfeiting is a dynamic trade financing method. In this process, exporters sell their foreign receivables, either for a long-term or medium-term duration, to a forfeiter at a discount. The forfeiter, in turn, receives the sum due from the importer on the agreed-upon payment date. A key characteristic of forfeiting transactions is their non-recourse nature. This means that in the event of default by the importer, the forfeiter has no right to recover payment from the exporter. The benefits of forfeiting are significant for exporters. It enables them to enhance cash flow by receiving immediate payment for their receivables, eliminating the need to wait until the scheduled payment date. This flexibility allows exporters to engage in long financing terms with foreign buyers. Though exporters may incur higher fees with forfeiting, the trade-off lies in the reduced risks of non-payment. Primarily utilized by large and medium-sized institutions and government agencies, forfeiting becomes especially attractive in high-risk markets. The payment periods for foreign buyers can range from 180 days to 7 years, making forfeiting a versatile financing option for a variety of trade scenarios. Eligibility and characteristics. Forfeiters need specific information to engage in a transaction successfully. 1. Nationality and identity of the buyer. 2. Description of the products for sale. 3. Value and currency of the contract. 4. Date and duration of the contract, including credit period, number, and timing of payments. 5. Evidence of debt issued, such as promissory notes, bills of exchange, or letters of credit, LCs. 6. Identity of the guarantor of payment, or avalor. Features of forfeiting. Several features define a forfeiting transaction. 1. Minimum payable amount of either US $250,000 or US $500,000. 2. Credit terms ranging from 6 months to 7 years for the importer, payable in major convertible currencies. 3. An agreement for the supply of goods and services. 4. Banks issuing LCs or guarantees to importers, usually in their home country, to facilitate the transaction. Why forfeiting occurs? Forfeiting comes into play when an exporter lacks sufficient working capital or requires immediate funds. It is also a strategic choice when the exporter seeks to eliminate the risk of default by the importer. How forfeiting works. The forfaiting process unfolds in several steps. 1. The exporter selects a forfaiter and enters into a forfaiting agreement. 2. An agreement is established between the importer and exporter. 3. The importer secures a guarantee from their local bank. 4. The exporter ships the goods. 5. The exporter submits required documents to the forfaiter. 6. The forfaiter pays the exporter the agreed-upon sum, gaining control over shipment documents. 7. At maturity, the forfaiter presents documents to the importer's bank. 8. The importer's bank collects payment from the importer. 9. Payments received by the importer's bank are routed to the forfaiter. Documents required in forfaiting. Essential documents for forfaiting include 1. Letter of guarantee or AVL. 2. Copy of the commercial invoice with a signature. 3. Copy of the sales agreement or payment schedule. 4. Letter of assignment and notification to the guarantor. 5. Copy of shipping documents including receipts, railway bills, airway bills, bills of lading and documents of title. In countries where the validity of the AVL is not recognized, an importer may issue a guarantee in its place. Alternatively, a guarantor may endorse a blank endorsement or a standby LC may be utilized. In conclusion, forfaiting in international trade serves as a strategic financial tool, providing flexibility and risk mitigation for exporters and facilitating smoother transactions in the global marketplace. Thanks for watching.